Hi, welcome to the Crypto Republic. Before we begin today, if you're serious about staying ahead in this once-in-a-lifetime financial shift, make sure you like this video, drop a comment, and subscribe to the Crypto Republic. Hello, XRP Army, and welcome back to the Crypto Republic, your go-to channel for the latest technology updates in digital assets. Before we get started with today's business, make sure to smash that like button, ring that bell, and subscribe to the Crypto Republic, bringing you updates every day at 9, noon, and 7 p.m. Eastern Standard Time. And here at the Crypto Republic, we give you the bird's eye view, a satellite perspective to spot the big picture shifts while everyone else is stuck in the daily chaos. Just a reminder, this video is for educational purposes only. This is not financial advice. Always do your own research before making any investment decisions. Something isn't adding up with XRP right now, and it's not the price. The Clarity Act is being framed like it solves everything. Like once this moves, the path is clear. But when you look closer, parts of this story stop lining up. That matters. Because if the narrative is cleaner, then the reality of a lot of people could be reading this moment the wrong way. The deeper you go, the more important that becomes. Let's zoom out for a second, because this is not just about XRP, and it's not just about one bill in Washington. This is about how financial systems actually change. Most people think these shifts happen with one headline, one vote, one big announcement. They don't. They happen in layers, quietly, through infrastructure, compliance, and institutional positioning. We saw that with the internet. We saw that with electronic trading. And we've seen it every time old financial rails start giving away to new ones. That's why this moment matters. Because on the surface, the Clarity Act looks like progress. And it's progress, but underneath that, there's a more important question investors should be asking. What exactly is becoming clear, and why isn't it still here? Because price is reacting, headlines are moving, but the system itself is still evolving. And once you see that distinction, this whole XRP story starts to look very different. I just want to thank everybody, ladies and gentlemen, that takes the time to like, subscribe, comment, and share on our videos. These few things really do help the channel growing, and I love answering everyone's comments when I get a chance. With that being said, I hope everyone enjoys the content. Let's dissect this. Let's zoom out further, because this isn't just about crypto. This is about financial evolution. Every major shift in markets has looked like this. Messy, confusing, misunderstood in real time. Short-term noise, long-term structure. Price is reacting, but the system is evolving. The Ripple signal, institutional validation. Now bring it back to today. Ripple just received a BBB investment grade rating from Kroll. That's not hype. That's institutional validation. It reflects financial strength, execution, stability, and most importantly, readiness. But here's where it gets interesting. Ripple is building infrastructure through Ripple Prime. They sit between traditional finance and digital asset markets. Scale, what most miss. Ripple works with over 300 financial institutions globally, including Standard Chartered, Bank of America, PNC, and that's just what's public. Then came the integration of G Treasury, now Ripple Treasury, adding a pipeline of 13,000 banks. This isn't early adoption. This is scaling infrastructure. Let's talk noise versus reality. You've probably seen the noise around Avalanche, claims of bank adoption. Then Brad Garlinghouse responds, living rent-free in your head. One side is talking. The other side is operating. Clarity Act, now to the core topic. Coinbase suggests rapid progress, but timelines like this that raise questions. Yes, moving is happening. Yes, a Senate Banking Committee markup is significant. But clarity doesn't arrive all at once. What's not being said, this is important, ladies and gentlemen, let this sink in. The Clarity Act aims to define SEC versus CFTC roles, establish token classifications, create market structure. But structure is one thing. Implementation is another. And this is what most investors are missing. XRP implications. Every node highlighted key implications. Holding over 463 million XRP, they outlined institutional compliance clarity, expanded infrastructure, defined taxonomy, legal framework, potential global standard. Important, but not instant. This is the macro reaction. Markets recently pulled back, driven by comments from POTUS regarding Iran. Oil moved higher. Markets went risk off. Crypto followed. But fundamentals didn't change, ladies and gentlemen. Let that sink in. The real story. This is about system transition. From slow settlement legacy rails to on-demand liquidity, real-time infrastructure. And XRP sits in that transition. So what to watch? Watch regulation progress, institutional onboarding, infrastructure growth, not just price, ladies and gentlemen. Most people are focused on price, but the real edge is understanding what happens next. That's why we build tips from the pits, because information alone isn't enough. Positioning is everything. Ladies and gentlemen, Ripple is building. Regulation is forming. Markets are reacting. But something isn't adding up because the story behind being told is cleaner than the reality unfolding. Short-term noise, long-term structure. If you got value from this, drop an X in the comments, like the video, subscribe for more. Stay sharp, stay informed. I'll see you on the front lines. Love all one of you. Well, ladies and gentlemen, happy Monday. To the most important part of the business today, I want to give a big birthday shout out to Joshua. Happy birthday, brother. It's your day. It's your day. Happy birthday, big brother. Ladies and gentlemen, the market structure right now, and if you're new here, it's time for the Italian ice. It is following everything that we've been talking about. So I have to ask a question. How much does everyone here love knowing what's going to happen before it happens? Right? You're lucky enough to found this channel and you're still here, and you probably let this video run, and then you realize that I'm not an AI person and there's a lot of value to gain here. Definitely give me a thumbs up and a chuckle, because what we've been talking about has been happening, and it's happening very interesting. One of the biggest things to pay attention to what came out of China closing off airspace for a period of time. There's so much happening, right? And there's a lot of things happening. But ladies and gentlemen, I want to welcome all the members of our membership channel, all the new members of the Patreon. One good tip from the pits can easily pay for your entire year subscription. If you want the deeper macro research and more importantly, how to actually position around all of this, do come and join us. We're approaching 500 active traders and investors inside the Crypto Republic Desk Monthly. And again, ladies and gentlemen, here's the part that frustrates me about everything that's going on. Again, there are two dimensions, and I want to address this right now. The first is the lead up to where we are today, the underlying setup that shaped current conditions. The second is the path forward, how this situation is likely to evolve if we treat this moment as a starting point. This is really, really big. Let me begin with the setup. Roughly a month ago, when tensions first escalated, widely misunderstood assumption took hold that releasing strategic petroleum reserve would meaningfully stabilize price. From my perspective, and none of this is financial advice, anyone that retains any capacity, in my opinion, that was never going to be the case. The issue was not and is not the absolute quantity of oil available, ladies and gentlemen. The constraint lies in logistics and conversions. Last video, we went over about all the VLCCs that are going to have to be around the North Red Sea. Again, stay with me. Specifically moving crude through this system and transforming it into usable products. Strategic releases are inherent localized, while global supply chains operate with time lags. At the same time, there were already shipments in transit, tankers that had been moving through the system for weeks, which are now arriving and being absorbed into supply. What that reserve release actually accomplished was not stabilization, but a deferral of price. I have consistently emphasized the principle that applies here directly. Government intervention does not alter the underlying trend. It only changes the timing or speed of the expression. Please write that down. Again, government intervention does not alter the underlying trend. It only changes the timing or speed of its expression. In this case, intervention delayed the inevitable adjustment. It effectively pulled future supply into the present, creating the appearance of relief while leaving the structural imbalance intact. The result is not a gradual easing, but rather the postponement of an acute disruption instead of an immediate break. The system simply shifts the stress forward in time. We are now beginning to see the delayed pressure of reemerge almost visibly in refined products. This brings me to the second critical point. I'm trying to take the PhD out of PhD for you, ladies and gentlemen. There's no shortage of crude oil in the great terms. The real constraint is in refined outputs, with diesel being the most component of everything. Diesel is not just another fuel. It's the foundational to the function of the global economy, transportation networks, industrial activity, agriculture, and even aviation, and all the direct and indirect tied to diesel availability. Diesel fuels the world, ladies and gentlemen. Without diesel, you got gas, you got nothing. You get chopped up like sushi. And believe me, people are getting chopped up like sushi in this market for just going to swim where there's no lifeguards, trading without stop losses, position size, FOMO, lions and tigers and bears, oh my. Ladies and gentlemen, we're approaching one of these famous times. I say, please return to your seats, ladies and gentlemen, buckle up, because we're about to lose cabin pressure. When diesel supply tightens, the effect cascades across the entire system. Recent price movements, particularly a sharp increase in diesel and jet fuel, reflect not only genuine supply constraints, but also anticipatory behavior. Market participants are beginning to secure supply ahead of further disruption, which amplifies the imbalance. At that point, government response becomes predictable. Authorities typically employ a dual approach: price management and access control. So on the other side, they attempt to limit visible price increases, often through tax adjustments. On the other side, subsidies. On the other hand, they quietly restrict access to preserve available supply. The combination allows them to maintain public stability while rationing underlying resources. Lower prices alone would accelerate depletion. That's so big to understand, which is necessary to offset the effect. This is not a contradiction. It's a coordinated response designed to manage both the perception and this physical supply. From there, the more important question emerges: how not quickly conditions normalize, but who benefits if constraints persist. In that context, China stands out as refined product of demand increases, particularly across Asia, where storage capacity is more limited and systems operate on a one just in a lifetime basis. Why I say just in a lifetime basis? Nobody stores oil. They don't really think. China follows a once in a very generational viewpoint to store everything. They're playing for keeps, ladies and gentlemen. What begins as a preference for dollar-based trade, ladies and gentlemen, settlement mechanisms shifts to a mechanism to provide more reliable access to energy. This is how structural shifts occur, not through policy declarations, but through necessity. So what this means in English: China is relatively well positioned in this environment. It's been actively building reserves and preparing for supply disruptions. In contrast to many regional economies that are more exposed to short-term supply volatility, that preparation provides flexibility at a time when others are constrained. And at the same time, it's important to recognize that this is not a one-side dynamic. Any significant escalation, particularly one that disrupts infrastructure or supply routes entirely, would carry substantial consequences for all parties involved. China depends heavily on imported energy. Iran depends on energy revenue, and Western economies depend on systematic stability. This creates a situation where pressure increases, but full-scale disruption remains unlikely. In my view, the broader context is increasingly geopolitical rather than purely economic. So what we're seeing aligns with a longer-term strategic pattern: prioritization of regional stability within the Western Hemisphere, even as global conditions become more fragmented. The underlying objective appears to be insulation, ensuring that domestic systems remain resilient in an environment where external systems may become less. So from a structural standpoint, again, taking the PhD, stay with me, the Western Hemisphere is relatively advantaged in this regard. It is resource-rich, geography insulated, and less dependent on tightly interwoven supply chains compared to Eurasian systems. As global independence is tested, these differences become more pronounced. We're not suggesting that outcomes are fully predetermined, nor that every development fits entirely into a single framework. However, the direction of travel is becoming clearer every day with what's happening. This is not a sudden collapse scenario. It's a gradual reordering under stress, driven by constraints in logistics, refining capacity, and access to critical resources. So, ladies and gentlemen, here's the key takeaways. SPR releases did not solve the problem. They delayed it. The system is not, it's now absorbing the delay in form of refined product shortages: diesel, jet fuel. The real bottleneck is not oil, it's diesel and refining capacity. This is where the pressure is building and where it will continue to show, in our opinion. Government response will likely combine price suppression with quiet rationing. If you look at what's going on in Japan, Australia, other places, you can start seeing it happen, even in England. Expect controlled distribution rather than open acknowledgement of shortages. Energy access is beginning to influence currency behavior at the margins. Countries may prioritize reliability of supply over traditional settlement preferences. China is structurally better positioned than many expect. Preparation and reserve accumulation provide flexibility in a constrained environment. Not many player benefits from full-scale disruption. The system is being distressed, not broken, which suggests continued volatility without a total collapse. What this means for you and me: expect continued volatility, not resolution. The underlying issue has not been fixed, only delayed. Focus on structure, not headlines, price movements, and reactions. The real story is happening in supply chains and logistics. Watch where pressure shows up. This is so huge. I'm giving you our own recce here. If you're writing this down, you are loving being a financial mercenary and being the remora. Diesel, transport, energy-linked sectors will act as early indicators. Understand that the system shifts are gradual but persistent. These changes don't reverse quickly once policies are underway, Position with resilience in mind, ladies and gentlemen. Get that Gucci clarity, that Gucci conviction. Understand that the world in the trading situation is not a fair place right now. There are people getting chopped up every day, because they're not following strict money management or a plan. Environments like this reward preparation, flexibility, and long-term thinking. What we're watching closely, and anyone that retains any capacity, diesel inventories and spreads, global refinery utilization, shipping and freight costs, signs of subtle rationing, energy trade settlement behavior, strategic reserve policy shifts, development around choke points. Ladies and gentlemen, this is so crazy what's happening. I think even in the UK, you can only get like 2.5 liters right now. It's nuts. There is so much happening in the markets, and it's insane. It really, really is. Ladies and gentlemen, I've never seen a trading environment like this in my entire career. And the people that taught me everything, my mentors, never seen anything like this. People will retire off of these trading opportunities that have happened in this time period in our lifetime. Because what I'm talking about right now and what you'll see in English, that means if China, if it's pricing oil in renminbi and they got a storage amount over in China and countries need it, China will obviously sell it to them if they pay in renminbi, yuan. That's what that means in English. But this choke point is not going away, and it's going to create trading opportunities further downstream in so many things. Again, ladies and gentlemen, if you want to stay ahead of how this evolves, this is exactly what we're tracking inside the Crypto Republic Test Monthly. Real-time shifts, positioning, and how to navigate it as it unfolds. The goal isn't to react, it's to be positioned before the move. Ladies and gentlemen, one good tip from the pits can easily pay for your entire year subscription. If you want the deeper macro research and learn how to take advantage of all this, come and join almost 500 active traders and investors in the Patreon, the Crypto Republic Test Monthly. We're doing it every day. And why I say that, I keep saying most people are missing the edge here, is you got to react to the news by positioning further downstream. Being a financial mercenary, we take advantage of all of this. Being the remora, we're swimming underneath the people who are tweeting. We're doing what they're doing in English, ladies and gentlemen. That's why we don't get cut up like sushi. As a financial mercenary, every day we go into combat. We're outrun, we're overrun. Every day it affects us. Our energy, our bob, food. I mean, look, we gave out a call in OJ that's spectacular. I mean, everyone can laugh. I love the movie Trading Places, but I love trading OJ. It is so lucrative when you see what's happening and you map this. It's unbelievable. There's just so much. But let me start with a contradiction that should not exist in a functioning market. Ladies and gentlemen, gold demand in China is holding strong, while prices are nearing historical highs. Now, if you understand markets at even a basic level, that should immediately trigger a question. Why isn't demand collapsing? Because normally when price increases by this magnitude, you see demand destruction. Instead, what we're seeing is demand persistence. And when demand persists at elevated price levels, that is not speculation, that is strategic allocation. Macro regime shifts, ladies and gentlemen. Come on, let's quantify what's driving this in English. On the ground, institutional sentiment is converging around a specific macro theme: stagflation risk. That means growth decelerating, inflation remaining structurally elevated, policy tools becoming constrained. Now, here's where it gets critical. You map the environment. Historically, you get negative real yields, currency instability, declining confidence in forward guidance. And in that regime, gold doesn't perform. It reprices structurally. What's being priced right now is not a cycle. It's a regime transition. Write that down. It's massive. The demand resilience. Let's go over the numbers. Not financial advice, just my opinion and retains any capacity. Let's get precise. Let's get laser focused. Or as the surgeon Domenico would say, let's send it. At the start of 2026, gold demand remained firm even after record price levels. Net imports into China were with historical averages. Despite elevated prices, onshore premiums remained consistently positive, signaling continued physical demand. Think about that. Imports are not collapsing. Why? Premiums are not compressing. Why? Which tells you something so important. The marginal buyer is still active. Physical demand is not being crowded out. The system is absorbing higher prices. This is a textbook sign of inelastic demand under macro stress. You got to let that sink in here. People getting cut up like sushi. I mean, we got some kind of conference going on right now about what's gone on. But at the time of this recording, I got to get this out, because if not, we won't be able to get a video out, because people that retain us want to be talking to us, and that's what we do every day as a financial mercenary. We represent ourselves, our families, because we put our reputations on the line every day. And this is when you shine, by being organized and understanding what's most important. Again, let's move into structural drivers, the structural policy distortion. Because this isn't just organic demand, ladies and gentlemen. This is policy-shaped demand. Here's what's happening. Investment gold remains tax efficient. Jewelry demand has become more expensive due to tax circumstances and changes. Financial institutions are scaling gold accumulation programs. Now, if you model this behavior, you're increasing the after-tax return differently between consumption and investment. You are lowering friction for systematic accumulation, and you are emboldening gold into retail distribution channels. This is not neutral. This is a capital flow reallocation mechanism, and it's working. Insurance flows. This is the big numbers, ladies and gentlemen. Now let's quantify the institutional side. This is where things get serious. Stay with me. Write this down. Insurance companies have been given permission to allocate up to 1% of assets under management into gold. Now, at first glance, 1% sounds small. Let's do the math. Insurance assets under management in China runs into the trillions of dollars. So even if we're conservatively estimate 3 to 5 trillion in assets under management, a 1% allocation, you're looking at 30 to 50 billion of potential gold demand. And right now, only about half of the eligible institutions are starting allocation. So the realized flow is likely to still be below 50% of potential capacity, meaning this is not a completed trade. This is a flow pipeline that is still opening. So if you look at the market microstructure and signals, let's zoom out into market structure. We're seeing increased turnover on the Shanghai Gold Exchange, persistent onshore price premiums, stable import flows through major channels. These are not headlines. These are microstructure confirmations of demand, because when trading volumes rise, premiums hold, imports stabilize. That tells you this is not speculative leverage. This is physical backed accumulation. So if you look at the February retracement, misread. Let's address the price drop. Again, gold correctly sharply toward the end of February. And we can't interpret that as a breakdown. We didn't, ladies and gentlemen. We shorted it. And everyone who is watching here, I salute you, because, again, if you're picking up on the trades and the things that we talk about, my financial advice, these are free. And if you're seasoned, you're seeing this, and it makes sense. If you watch every day, this makes sense. You understand what we're breaking down to you right now makes sense. You are not getting chopped up like sushi because you're following the chorus of chaos. You see what's happening, and you're getting stronger as a mariner to sail your boat of trading and lose sight of land and hoist the mainsail and capitalize on the winds of chaos, because if not, it blows you over. But let's analyze it properly. The correction triggered reassessment of entry levels, stress testing of long-term assumptions, practical patience among allocators. But here's what did not happen. There was no collapse in structural demand. There was no breakdown in physical flows. There was no dislocation in premiums. So that signal wasn't exit. The signal was reprice risk, but maintain allocation. So if you look at the silver liquidity metric that we look at, let's bring in silver as a secondary indicator again. Very important. Silver demand has shown strong investment increase, driven inventories levels lower over time, pulled supply away from Western clearing hubs. And this is key. When physical demand starts pulling metals away from London and Zurich systems, you're not just seeing demand, you're seeing liquidity fragmentation. And liquidity fragmentation increases volatility, basis risk, market stress. Ladies and gentlemen, if you look at systematic interpretation, again, trying to take the PhD out of PhD here, stay with me. We're going into XRP, ICP, HBAR. Why the anointed one? Stay with me. Let's synthesize all of this. You have persistent demand at high levels. Institutional allocation still rampant. Policy-driven investment incentives. Physical market tightness signaling macro conditions pointing towards stagflation. That combination is not random. That's what happens when capital starts hedging systematic uncertainty, not cyclical risk. So here's the real question you need to ask yourself, folks. If demand remains inelastic, flows are still building, institutions are underallocated, and macro risk is structurally rising, then what you're looking at is not a crowded trade. It's an early stage repositioning. And by the time that repositioning becomes obvious in price, the asymmetry is gone. Ladies and gentlemen, this is what we pay attention to. Again, this is what guides us. Again, so if you want to stay ahead of how this evolves, this is exactly what we're tracking inside the Crypto Republic desk. Real-time shifts, positioning, how to navigate this as it unfolds. The goal isn't to react, ladies and gentlemen. It's to be positioned before the move. Remember, One good tip from the pits can easily pay for your entire year subscription. So if you want the deeper macro research, one-on-one mentorship, and learn how to take advantage of all this, come and join almost 500 active traders invested inside the Patreon, the Crypto Republic Desk monthly. Again, ladies and gentlemen, and happy birthday, Josh, my brother. Woo! It's coming from Domenico. I see him on the chat right here, popping up. You got to understand something right now. Everyone's waiting to see if this deadline tomorrow is going to come and go. But if you're long-term members of the Wolfpack here and everyone who's learning in the Patreon, we're interpreting what's happening and why. This causes the easiest way when they manipulate markets through the news, and news manipulation of markets happens every day. I remember when I was first being told about certain agricultural crops. If it rained too much, the fruit would be one way. If it rained too little, the fruit would be one way. They used to burn down certain orchids in certain countries, influencing the price. I remember learning every trick of the trade on the floor of the New York Mercantile Exchange, becoming a financial mercenary to make me a more prolific financial mercenary, to make my bank account bigger. That's why I got to where I am today, and why I love everyone who is watching, because this is what we're built for. This is where we shine. Ladies and gentlemen, at some point, and if you're still here, I salute you. These turbulences will end. I can't see them really taking out certain installations, but if you wanted my perspective on this, and I told this to a family office, look, I hope everyone stays safe, and God bless everybody what's happening. Again, there's very troubling times we live in. But after what just unfolded in the last 48 hours, certain people have shown their hands and certain military assets were destroyed. So as far as we're concerned, in a capacity, maybe there'll be more time of speaking, because when you lose certain assets and you show your hand and you show what's really in place, sometimes that changes what you normally would have planned for and not planned for. Why I'm saying that is you had 100 special operator people that know they're there. You lost a couple planes that are vital to certain types of missions. You lost things that can't just be jockeyed one place or another. But that's not going to stop the tweets. We believe Bitcoin right now is a bellwether for risk. Goes right back to 70, gets shut down. If you look at XRP right now, trading around 134. If you look at oil, oil's like around 113 and change, hit 115. These markets are now in trenched ranges again. This is going to come to some plasmatic head, and if you're not paying attention, you will get cut up like sushi, carried out in a body bag. This is where you have to be so disciplined about what you do and why. But XRP every day makes inroads. Ripple every day weaves itself into the future of the Western tranche. Again, if you look at when I went over about the unit, the bricks, the east side of the tranche, right? They're about physical metals, HQLAs. They're about taking loans against their metals for infrastructure projects. Again, every project that we were involved with in Malaysia, we would go to Bank of Nagar and use treasuries. Now you can use gold when you're building things. Ladies and gentlemen, the world is changing. So when you see what's happening and the comments out of SBI about their viewpoint on Ripple and their viewpoint on XRP, what more do you need to see and understand? Again, the world is going to change. No matter what. It's like, you got to understand why you're in this and why. This is the biggest opportunities of a lifetime in our lifetime. And I'm going to keep saying that. Again, not only for accumulation, because as the news manipulates the situation, right, prices of assets will be depressed, allowing for accumulation. Again, as the Remora, we swim underneath anything. But do you realize the shortages that are going on right now because of this? Do you realize how that's going to affect prices downstream? That is why we understand what's going to happen, ladies and gentlemen. And it's so important. It really, really is. Ask yourself this. What do you think is going to happen and why? Every day, there's more infrastructure getting taken out. Every day, you get to the point of no return. Every day, there's threats being lobbed. Every day, we come to the inevitable situation that time is running out with this. So as far as we're concerned, you're looking at fertilizer shortages. You're looking at petrochemical disruptions. It impacts nearly every consumer in every industrial plant. You're looking at diesel and fuel costs over the primary transmission mechanism. It's massive what you're looking at. The system is currently running on old inventory. Ladies and gentlemen, You got to understand from a positioning standpoint, the environment shifts from optional awareness to required understanding. This is where core structure is changing, not temporary, but structural. You got to expect higher prices across essentials, food, transport, goods, increased volatility in commodities, and energy-linked assets. Ladies and gentlemen, there's so much happening right now, and there's so much opportunity because prices reacting, but the system's still adjusting. It really, really is, ladies and gentlemen. And ask yourself this. Do you think that this time period is going to stay like this? Do you? I don't. Ladies and gentlemen, again, if you want to stay ahead of how this evolves, this is exactly what we're tracking inside the Crypto Republic desk. Real-time shifts, positioning, how to navigate as it unfolds. The goal isn't to react, it's to be positioned before the move, ladies and gentlemen. I say this over and over again. One good tip from the pits can easily pay for your entire year subscription. You want the deeper macro research and understand how to take advantage of all this? Come and join almost 500 active traders, investors in the Patreon, the Crypto Republic Desk Monthly. With that being said, happy birthday, Joshua. We love you. This content for informational entertainment purposes only. Should not be taken as financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Always. Remember, the game is changing. Those who understand it first will benefit the most. Make sure you're on the right side of it. You've got two choices. You could be like the crowd, reacting after the move, rationalizing why they missed it, telling themselves they'll never let it happen again, or you can be the one who saw behind the curtain, the one who understood the infrastructure shift, the one who positioned early, not randomly, but intentionally. Because some moments in history are loud, but the ones that change everything are quiet, right up until the moment they're not. And this is one of those moments. Do not blink, because the world is distracting you with noise while XRP continues developing behind the scenes and building momentum in the broader digital asset landscape. Stay sharp, stay informed, accumulate knowledge. Your move now will be remembered. This is not the end of the story. This is just the beginning. This opened your eyes. Smash that like button, ring that bell, leave a comment, your thoughts. Turn on notifications, and most importantly, subscribe to the Crypto Republic. We break down the major global banking trends shaping digital assets today, giving you context, clarity, and research you can use. Don't just watch history happen. Stay informed, stay ahead, stay in the public. We love you all, everybody. Stay safe.